You want to know, what are the best stocks to buy now? I've got 5 stocks that I'm buying right here, right now. Let's go. The first one I want to cover today, we just started a brand new position in the community portfolio. Now, the reason for the stock being down is because, well, a couple different reasons, but this downgrade is putting pressure on Palo Alto. They're buying CYBR. And of course, with any kind of acquisition, M&A, especially in a hot bull market, you're going to pay a premium. We're talking about a $25 billion deal. Of course, it has to get approved by DOJ. And of course, following Alphabet Google's $32 billion acquisition of Wiz in March. The deal is putting CYBR at $495 a share. So we're talking about almost a 30% premium to Monday's close. Company's investors receive $45 in cash and 2.2005 shares of Palo Alto for each share they own. Now, this downgrade by KeyBank Capital, it's taking it to sector weight on Palo Alto from overweight, saying there are strategic concerns tied to the company's planned acquisition. So first of all, again, this has to be approved by the DOJ, but anytime you have M&A, you're going to have cultural differences. And of course, with CyberArk, this is located in Israel versus Palo Alto, which is going to be a California-based company. But what KeyBank is saying is they think customers will prefer to use an independent vendor solely focused on identity, like, for example, Okta. But is that really true? Because we've seen companies like CrowdStrike that have gone really just focused on endpoint security have gotten into identity management over the last several years. And coming from somebody who used to sell software, I would say it depends. You know, oftentimes a CIO, an IT organization, they're going to want best of breed. But at the same time, if you really look at what Palo Alto is all about, it's already the jack of all trades. We call it the jack of all trades, ace of none. It's a great company. It's number 2 in a lot of areas, but it's not necessarily like, for example, CrowdStrike. If you say, what's the best of breed endpoint cybersecurity company? It's CrowdStrike. That's my answer, hands down. Palo Alto is really good in a lot of different areas, but not necessarily the best of breed in just one area, but very diversified in its portfolio. So it does make sense if you understand what Palo Alto is all about. KeyBank is saying that this deal lacks the advantages of a replacement cycle or first mover edge. Does it naturally fit within the company's existing product suite? Interesting question. I've got your answer. Why does Palo Alto really want to acquire CyberArk? If you understand this, it makes it a lot simpler. They're doing it primarily because they want to get more into agentic AI identities. Of course, agentic AI is going to be huge for enterprises. There's a lot of total addressable market, a lot of demand, and a lot of money that can be made if you can focus on agentic AI and helping your customers. This is going to give you comprehensive observability and discovery, automatically identify and classify AI agents within your environment to maintain complete visibility and control. Gain complete visibility into AI agent activity, automatically discover and track every AI agent in your environment in real time. If you listen to Jensen Huang talk and he's telling you about agentic AI and what it's going to be like in the future.
And so AI agents will be everywhere. How they run, what enterprises run, and how we run it will be fundamentally different.
This M&A, this merger, this acquisition should get you very excited about Palo Alto if the deal goes through. According to a recent KPMG survey, right now about 33% of organizations polled use agentic AI in some capacity. AI agents requires a greater need for identity management. So we're talking about identity security, and that 33% number is supposed to grow to over 50% by the end of this year. Now, if you've been around the block, you know anytime there's an acquisition like this, the company that's buying, that's paying a premium, it's going to get whacked in the short term. And it might take some time, but it often creates an opportunity as long as that M&A unlocks strategic value and revenue generation. If we look at the most recent earnings call here from Palo Alto, this is May 20th, 2025. Overall, the numbers were pretty good. And the customers with the larger customers like 10 million plus ARR, that's up 63% year over year. This is what you want to see. So we're looking at strong momentum and customers are consolidating with Palo Alto. Also a robust pipeline opportunity in Q4. And they really are trying to focus here on innovation for the AI security era. And this is important to understand. Now, when you look at things like total revenue, 15% year over year, this company is no longer in the hyper growth stage. It's still a growth company, but it's not hyper growth. And remember, guys, Palo Alto is not built in the cloud for the cloud. So you do have some hybrid environments and lower margin profile. But when you're looking at like the next generation security ARR, that's where the growth is at, 32%. So this CyberArk deal is really trying to feed off of that momentum. Now, when you look at valuation, we like to look at those cloud and SaaS metrics. Keep in mind there is some hybrid here, so generally a little bit lower premium than something like a CrowdStrike might have. But the EV/NTM revenue for Palo Alto is around a 12x right now. The free cash flow, 34%, and that rule of 40 score is really solid. It's a 52% NTM. Just as a comparison here, CrowdStrike, you're looking at EV/NTM revenue, 22.3x, 27% on the free cash flow, and a 56% rule of 40. So pretty similar numbers overall, except CrowdStrike has a much higher valuation. Now, if you're more of a value investor, this is going to be hard for you to put a price on it because you're going to look at something like a GAAP 4P ratio and say 105.47 is way too expensive. Well, most of these cloud SaaS companies don't even have a GAAP P ratio to look at. For example, CrowdStrike, which has been a fired up well favorite since the IPO in 2019, doesn't have a score for you. If you're looking for a cybersecurity stock, we do believe this is still a secular trend where a lot of money can be made. But names like CrowdStrike, Cloudflare, Zscaler, Datadog, they're very expensive. This might be an opportunity here on Palo Alto. Let's look at a chart. I'll tell you where we're buying. So on Wednesday on chart day, I told the community, I said, hey, I think there's a chance this goes to 175. I think it's an opportunity when we get in that 175 area. When the stock was $200, $210, I told the gang, hey, I wouldn't touch it unless it's say 175, 185. My preference is really going to be something like 150, but I don't think you'll see that. So I did start a position here at under 175, a new position. And just keep in mind that this stock was $144.15 in April, so it certainly can go quite a bit lower. Again, use dollar cost averaging, DCA, but I think this is one of the more attractive opportunities if you're looking for a growth stock in a secular growth trend on the market right now. That's not crazy expensive. I believe this next stock is one of the best stocks that you can buy in the market right now. And I'm going to share why. Last night we had earnings. Qualcomm earnings were pretty good. They beat by 6 cents on the EPS. Revenue was in line, but only 10.3% growth. Now, if you look at the earnings, you can see negative year-over-year change here. Improvements, but a slowdown. And this is CDMA Technologies revenue. You can see it's been a little bit bumpy. Licensing revenue, well, we've got overall a decline if you look from 2022. And of course, we can also look at the different segments. You got handsets, you got automotive, and Internet of Things. Automotive has really been all over the board, but you can see it has slowed down here to 21%. Also a slowdown in IoT. Okay, so you're thinking, that's great, Eric, but what is the skinny? What's the story? Why are you bullish on Qualcomm? I believe that this story will take some time to play out. Qualcomm needs to live past the Apple fallout, more on that in a second, and rebuild revenue segments. I posted this in Discord last night. They're doing a great job. In fact, Qualcomm is even getting into data center. And I believe when you look at Snapdragon, there's a huge total addressable market for AI PCs and edge cloud computing. Now, this is getting more into what we call phase 3 AI. And so this is the time, I believe, to accumulate stocks like Qualcomm. With all that said, keep in mind, this is not a hyper growth stock. It's more of a DGIF stock, or you can call it a DGI. It's got a solid dividend over 2%. So the dividend safety score is an A-, dividend growth A+. You're talking about 2.24% dividend yield and 21 years of dividend growth. You can see the stock is down 8% today at 146. Profitability grade, you're talking about A+. And gross profit margins, these are solid, 55.68%. Remember, this isn't a software as a service type play. Solid margins overall. And the company's bringing in $225,000 net income per employee TTM. Valuation, guys, at the end of the day, this is a pretty inexpensive stock in a really expensive market. You're talking about a GAAP 4P ratio of a 16.16. The PEG GAAP TTM 0.53. The non-GAAP 2.04. $171 billion market cap, has 1.95% short interest. It's down 12% in the past year and down about 5% year to date. But back to my story here in Discord. Not huge growth, but still around 15% this year, which is solid for the price, attractive valuation, attractive dividend yield. Plus, Qualcomm said it spent just under $1 billion on cash dividends, $2.8 billion repurchasing 19 million shares of its stock during the quarter. That's a positive thing I want to see as a long-term investor. So revenue from chips used in vehicles, automotive rose 21%, but I showed you that chart earlier. It's actually down from previous quarters. And connected device semiconductor sales, 24%. The main challenge here, why it's in the penalty box and why people aren't more aggressive buying it. The challenge for Qualcomm is Apple's decision to make its own modem chips for the iPhone. That used to be a significant part of the revenue. It still is, but it's less. And Qualcomm is working to find these other revenue segments to replace this revenue from Apple. I do believe that Qualcomm will overcome this. They're even, like I said earlier, getting into data centers. One of the few stocks to me that stands out in this market. You know, every Wednesday we do chart day in our private community. When the stock was up here 230 bucks, I was like, hey, I wouldn't touch this over $175. Well, now it's $146. And I do want to touch it. Can the stock go lower? Of course, the answer is always yes. And this S3 Fibonacci support 3, you're looking at about $137. Right now, it's sitting around this S2. It's getting close to that, at least 144 and change. We're at 146 and change. Now, my expectation for this stock is probably something like 10 to 12% plus the dividend. And I'm talking about annualized returns over the next, say, 5 years. Maybe some upside to 15% or more. But this is not a stock you're buying for hyper growth. It's really a higher quality name, I believe. It pays you that nice dividend and the valuation isn't crazy. The risk, of course, is that they lose all their revenue from Apple and all their new revenue segments fail and the stock could be much lower. But when I look at the management, the overall dividend safety, the balance sheet, I have confidence that this is going to do well for me. And it's a good fit for my main portfolio and my dividend portfolio. So for me, in my situation, I want to accumulate shares of Qualcomm, $150 or less. DCA, of course, the lower the better. Keep in mind, the stock was $120.80 in April, so it can always go lower. This next stock, you guys, has lost about one third of its market cap in today's trading session alone. It's currently down 32.58%, trading at $17.80. Now, what's crazy about this is it's even showing a PE ratio. The problem is it's too expensive for the growth. At least that's what the market's saying. The numbers don't look bad at all. When you look at the earnings report, in fact, beat by 1 cent. So this is non-GAAP EPS, but this is not uncommon for these kind of stocks. This is a cloud SaaS. It was an open source that's getting more into the SaaS recurring revenue model. Revenue 20.1%, so a little over 20%, beat by 3.87. So you got a double beat. And of course, the guidance was a little bit light, but this 33% sell-off, it seems a bit like an overreaction to me. Of course, you're seeing downgrades. Stifle today downgraded the stock to hold from buy. And a lot of analysts had buy ratings when it was, just 33% higher, reducing the stock price, the price target from $30 to $21. Ouch. I mean, this is significant. $21. It's trading at, $17, $18 right now, but you're only talking about a $3 upside on the target. This is pretty bad news. So I think the stock can go lower. I'm going to look at a chart here and show you where I think it could hold up. But Stifel's downgrading shares of Confluent to hold as continued cloud usage optimization, slower net new workload activity, lackluster new customer adds, and an AI customer that is moving from cloud to self-managed platform. This is probably the biggest thing right here. You've got a current AI customer that's essentially ripping and replacing, and it's going from the cloud to the self-managed platform. Now, self-managed platform, it's still part of Confluent, but self-managed, they're not making the money off of that cloud revenue. Again, this is an open source with a cloud option, a SaaS option. So that means meaningful cloud growth headwinds in coming quarters. All right, so this stock could be a dog for quite a while, and if you're buying it, you have to make sure you understand this. Let's look at a contrarian view to this. Guggenheim said the steep drop in shares is a market overreaction. I tend to agree, although I'm usually pretty neutral. I'm not going to be surprised if a stock rips, if it dips. It's just the way it is. These are what we call high flyers. I always tell you names like this, they get popped 30% on earnings or drop 30% in earnings, and here we are. Yes, we understand the key issue is the continued optimizations among large customers, and particularly this large AI native customer, resulting in NRR downticking to 114%. Implied cloud exit rate of plus 18% versus the streets plus 24%. But we see a 4Q cloud exit rate of 21% and subscription exit rate of 19% as plausible, resulting in 21% full year subscription growth or modest upside potential. So Guggenheim reiterated its buy rating and slightly lowered the price target from 31 to 29. Well, I can work with 29. It's much harder to work with 21. RBC agreed that this was an overreaction. Price target from 28 to 25. Needham reiterated a buy rating and nudged down the price target to 24 from 26. So definitely some concerns, and that's why the stock is down. Is it an opportunity to buy? Well, it's going to be up to you and your blueprint. Let's look at a chart. Okay, so this stock got up to $37.90, fell off a cliff to $18 in April, did recover back to around $26, $27, and you can see it's fallen back and actually retested $18.27 and broke that from the April lows. So this has really been kind of a range-bound dog for quite a while. And this is something that I do own in the community portfolio. Did nibble some shares today. I'll share some thoughts on that. But you can go back to all the way to 2022. This was a $16 stock. And yes, at one point it was $38 and then yo-yos back to this $16, $17 price, back to 35, back to 17, back to 38. Here we are again. So you're really trading in this channel. You know, it's essentially this channel that's, if you look at this blue line up here, I mean, give or take, you're trading in this pretty large channel. It's almost like traders just like to buy it here and sell it there kind of a thing, right? So is this an opportunity? Well, if it holds up this kind of support area, this $16, $17 area, recently here, it's been $17.79, $18.27. If you go further back into, you know, basically the bear market of 2022, you're talking about $16.50, $16.60. So could it get down to that? Yeah, it could. I think it probably tries to hold somewhere in the 17s. Could it drop and go to 15? Absolutely. I look at stocks when I'm buying these when they're down. You want to give them usually a couple of days, but at the same time, I like the dollar cost average because I'm never going to time it perfectly. Now, if you think of a stock like MongoDB, you know, it had a sell off like this and it just kept dropping, you know, falling knife. Could that happen? I think the answer is absolutely yes. But if I'm buying and I'm dollar cost averaging and saving room in case it does come lower, if I look at the risk reward, you know, the downside to me is fairly limited. I've got kind of a floor to work with, where the upside, it might take a while, right? It could take a year, even 2 years to get back to $40. But if I buy it at 17 and it goes to 38 in 2 years, I've done pretty well. And remember, a lot of the stocks in the market are very expensive. So this could be one of those opportunities. Be careful though. I tell you this all the time. Don't go out and buy a stock just because you think it's on sale. Make sure you understand it. Does it fit your blueprint? This is still expensive. It's a high flyer. It's one of these cloud SaaS names. It's not a cheap stock, right? So make sure it fits your blueprint, your DNA. Do your homework before you make any buys. We did buy some in the community, quite a few buys, you know, under this $18 range, in the $17.50 to $17.85 kind of range. But keep in mind, the stock can certainly go lower. Next, I got a 2-for-1 rapid fire and significant amount of DD that I'm going to give you for absolutely free. One's going to be a write-up and one's going to be another video here on YouTube. But before I do go on, if you're new here and content like this is helpful to you, make sure you subscribe and click that bell for notifications. And if this video was helpful, please return the favor, drop me a like and drop me a comment. So this first stock, you can go read a due diligence write-up, a very extensive write-up that I did on Patreon, absolutely free. The link is in the description of the video below. Go check this out, read through it, of course, make your own decision. This is Clearwater Analytics. The ticker is CWAN. It is going to have earnings here on the 6th of August. So that's next week. We're going to have earnings, and this stock could sell off. It could pop or drop. This is another one of those SaaS, you know, software as a service, SaaS, cloud type names, high flyers. So it could do a Confluent type thing. Keep that in mind. I like this stock, $20 or less DCA. I did start a new position around $21 in the community portfolio, and I've been DCAing. I've told the gang, I think that it could certainly go below $20 on earnings. This S3 Fibonacci support 3, $18.73. Of course, dollar cost average, make your own decisions. And the last one, I just did a video on Tuesday, a deeper dive. Is UnitedHealth a buy? Why is this stock down so hard? I told you on that video that I thought it would go below $250. And literally 10 minutes ago, the stock just dropped below $250. So take a look at that video, but I do think UNH is an opportunity, $250 or less DCA, but watch the video to understand, because it's not the best fit for every person and every portfolio. Thanks for watching, guys. Have a great rest of your day. Take care.